Hi, it's been 2 weeks since I've talked to you because I've been flying around to various conferences, and so now I'm back on solid ground, and I've been paying attention to the discussion forum, and I'm interested by this thread on quantitative easing. As most of you seem to appreciate, quantitative easing technically involves the central bank buying some kinds of assets. In the case of the United States, we're talking about long-term treasury bonds by expanding its liabilities. In this case, we're talking about reserves. So this is expanding both sides of the balance sheet. How exactly is this supposed to work? Now, in the standard discussion that you will hear if you look on the Fed website and if you look in the normal journalistic outlets, there's sort of 2 points of view. One you might think of as sort of Keynesian point of view. This is the view of Yellen and Bernanke and the Fed itself, that the idea is we're trying to take duration risk, so-called duration risk, out of the economy, and so in so doing, lower long-term interest rates. And the idea of lower long-term interest rates is to stimulate investment spending or something like that in order to get the economy going again. This is sort of expansionary monetary policy, but not by manipulating the short-term interest rate because it's already near zero, but by manipulating the long-term interest rate. That's the explanation. Now, the standard view on the other side, which is coming from finance, Gene Fama recently articulated this after receiving the Nobel Prize, saying that that doesn't really make any sense because what you're doing, it's true that you're buying long-term bonds and that sort of puts upward pressure on their price and downward pressure on their yield. But you're also increasing liabilities in the short term, and that should put, in fact, upward pressure on short-term interest rates instead. And so there should just be a twist going on there. You shouldn't really be changing the level of interest rates in general. You're just changing the structure of interest rates. That seems to be his point of view. Now, the money view, which is the view that I develop in this course, is a little different from both because it's emphasizing how these trades are playing out in money markets. What are the consequences for money markets? And here I would point to two particular consequences. One is this is an expansion of Federal Reserve liabilities and therefore a particular kind of money relative to other kinds of money. And so what happens? And there are two margins along which I think we need to analyze this. One is the relationship of high-powered money, Federal Reserve liabilities, with private bank money. What is going on there? Now, those are supposed to be trading at par, so they're perfect substitutes in the marketplace, and you get more of one kind. What seems to be happening is that you then get less of the other kind. If people are able to hold their money balances at the Fed, they prefer that to holding money balances in the private banking system. The Fed is a better counterparty. So there's sort of a crowding out going on there. But what that means is that the aggregate money supply isn't really expanding, even though the Fed is expanding its part of the aggregate money supply. And so you wouldn't expect to see the kind of effect that Fama is expecting to see in the short-term money market because there's a substitution in supply, that is absorbing this. It's not being absorbed in prices. So that's one margin. The second margin, and I think maybe more important for understanding how this is playing out, is the margin between dollar money and other kinds of money, foreign exchange. Here, you would expect that quantitative easing should be causing the dollar to depreciate relative to other currencies, and so it did. And the question then is, well, how are other countries going to respond to this? Are they going to, is this depreciation of the dollar making them uncompetitive? And so do they then want to have stimulation of their own kind? Are they going to follow the U.S. down that road of quantitative easing, or are they not? And when you reverse this quantitative easing with so-called tapering, the reverse is the true. The reverse is what happens, meaning that the dollar tends to appreciate and other currencies tend to depreciate. And are you going to fight that with your reserves, or what are you going to do? And this is why the policy of the Fed is very closely watched by other central banks, because the dollar is the world reserve currency. And so when the Fed moves, everybody else has their consequences for everyone else. These two effects, I think, are well known in the marketplace. but seem not to be very well known in the analysis that we see in journalism. This is one of the reasons why I'm making this course, to get the money view, to get this sort of practical side of the markets out into the conversation, where I think it can contribute something to the debates that we're having about the role of central banking, about the future of global finance.